It's time for the Your Personal Bank Show with Ferenc Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with Your Personal Bank. Now here's Ferenc Toth.
Welcome to Your Personal Bank Show today, and I just had my headphones almost blow my ears out. Anyway, we got a lot of good stuff to talk about today. It's going to be fun. One of the things I really want to talk about today is income. I was reading some articles here recently. So if you're really, there's a lot of people, and I'm running into this more and more, folks reaching out to me. It's like, where's a good source of, finding somewhere I can put my money and get a decent return on the money? In fact, I was talking to a client, a longtime client of mine, on the phone, even on the drive in here into the studio. And that was, one of her questions is, where can I find a decent return? And she's retired. So a lot of folks who are retired or nearing retirement, looking to supplement that retirement, looking at options in terms of where can I get a decent return on my money, so I can live off of it, supplement retirement, obviously. And with the, as anybody's paying any attention knows, we've been in a historically low interest rate environment basically since 2008, 2009 time frame. So that, we've gone through like a 12-year period now of historically low interest rates. And of course, with COVID, when that hit, they were starting to, inch up a little bit the last 3 years. But of course, COVID, the Fed dropped them right back to rock bottom again. And, the latest from news from the Federal Reserve has been they're talking about keeping this current low interest rate environment around at least to the end of 2022, they're saying. So if that's the case, which very likely looks like will be, we're looking for another couple of years or so of probably, the lowest interest rate environment, frankly, of just about anybody living. So nobody alive pretty much has seen this kind of low interest rates, much less for this time frame, this extended time frame. We could be looking at a situation where, again, literally, the low interest rate environment could be in place for 15 years or more altogether. And that's historical. So, you see a lot of these articles talk about, where places to go in terms of, looking for dividend paying or income earning type of assets. And, the normal ones come up and, bonds and dividend paying stocks and annuities, savings accounts, various things. But, here's the thing, like this one article from Motley Fool talks about, they're really talking about how dividend-paying stocks can be a good solution. Here's the problem that I have, and when I read this, I almost had to laugh out loud, and it was a sad thing though. It wasn't funny. You'll get what I'm trying to say. So the point they're making here is they're talking about the dividend aristocrats. Now, those of you that may know what dividend aristocrats are, it's basically these are dividend-paying stocks. Understand, these are stocks that are designed, you're not looking for appreciation. You're really looking for dividends off of these, or income, right? And like I said, the dividend aristocrats are companies that have been, like they point out, have been paying increasing their dividends each and every year for like the last, 25 years or so, okay, which is great, okay? And there's a list, like I said, companies have increased their dividend every year for at least the last 25 consecutive years, okay, which is awesome. The thing is, though, when I looked at it, and they're talking about the different rates on some of these dividend aristocrats, and in this article, from Motley Fool, it talks about, Walmart, Procter & Gamble, and Coca-Cola, for example, and their current dividend yields currently are 1.49, 2.19, and 3.29, respectively. And I'm thinking to myself, people are buying these. Now, these are the best and the brightest. I mean, if the dividend-paying stocks, if you're purchasing these for income, these are, they state, the best and the brightest, the dividend aristocrats. And I'm thinking to myself, we've got companies that have been paying 6% dividends for the last 25 years plus. Never missed dividends since before the Civil War. Why isn't that being considered? See, that is probably the thing that I was going to say surprises me I guess it used to surprise me. I've heard it so many times it doesn't surprise me anymore. But it's one of the most common statements I hear all the time is when I talk to somebody about the personal bank concept, again, using high cash value policies and then combining that with to get a high dividend and then combining that with a bank line of credit to access those funds to create positive arbitrage. And I've stated over and over again, there's multiple companies that have paid 6% plus dividends for 25 years plus. This whole article is talking about and bragging, rightly so, about these dividend aristocrat stock, dividend-paying stocks being the best. And that's great. But I'm sorry, 1 to 3%, in my opinion, just doesn't cut the mustard. I mean, it's better than nothing. But if somebody's looking for income, really truly looking for income, why not consider the personal bank concept? Why not consider a company that's paying a 6% dividend? By the way, we structure that correctly. That can be 6% tax-free dividend. Okay? Now, even with costs and fees, that's one of the questions I get all the time. What are the costs and fees, insurance, and things like that? Okay? Even if it was 1%, which in a lot of times it's not, but even if it was, we'd be so far ahead. You'd still be at 5% range. I mean, even if you're a 4%, 4 or 5% range, and that would be extraordinarily, high. If somebody's really age and health and things like that, that would be extraordinarily high. You're so far ahead of a dividend, what these dividend-paying stocks are paying. So again, the biggest surprise that I guess prospects, clients, people that I talk to, and I get this, in fact, I got this response recently, just a couple of weeks ago, medical professional that I know, known him quite some time. And in fact, our daughters have gone to school together. That's over a number of years, and that's how I knew him. And talked to him briefly about various different things. But he's been investing in things for decades, of course, and listened to this show recently, and sent me an email and said, "Wow, I was surprised. I didn't realize." I had no idea that there were companies that were paying 6% dividends and had done that for the last 25 years plus. That's probably the number one reaction I get, most common reaction I get when I share with people. I'll show you the charts. I'll show you which companies, what companies have been paying, the top dividend payers out there for the last 25 years. And like I said, when I meet with a client or talk to somebody and we're online, or typically it's online, go to meeting, Zoom, that kind of stuff. Literally, when I show you the chart and you see what the company's been doing, it's obvious within a matter of minutes. You know who you want to work with. I mean, it's abundantly obvious. The response I get consistently is, "This is a no-brainer." And I'm like, yeah, I hear that all the time. Okay? So the thing that amazes me, I guess, maybe that's a better word, is here there's companies that have been out there for over 100 years paying these strong dividends, have paid these 6% rates for the last 25 plus years. Yet people are looking at buying things that are paying half or a third or even less for income. If you're looking for income to supplement retirement, you really need to consider Your Personal Bank. So contact us at yourpersonalbank.com. At least take a look. And then we'll talk about some more about this in the next segment.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back. We're talking about income today. And again, the challenges of this low interest rate environment that we've been in. Well, frankly, since the 08-09 recession, we've pretty much been in this environment. The Federal Reserve has stated they're going to keep the interest rates where they're at probably through the end of 2022, at least at this point. So we're looking at some long-term historical low interest rates. And that is, of course, affecting anything revolving income or dividend type paying, interest paying assets. And like these articles I'm referring to, things like dividend paying stocks, bonds, savings accounts, checking accounts, CDs, all those types of things are being affected strongly to the downside because of this really low interest rate environment. And so I've been reading, there's been a lot of articles recently about where, and a lot of my clients have been reaching out, where do you go to find a decent rate of return on your money so that you can supplement retirement? And, income, dividend paying kind of stuff. And that's tough. And one of them I pointed out in the first segment was talking about the dividend paying stocks. And this article from Motley Fool, and it even goes into like some of the dividend aristocrats. These are the companies that have been increasing their dividends every year consecutively for 25 plus years, which is great. But the examples they used here in this article even point out they're talking about companies like Procter & Gamble and Coca-Cola. They're paying like between 1% and 3% range. And, we have policies of paying 6% dividends for the last 25 years, plus never missed a dividend since before the Civil War. So my point is, I'm shocked. I'm shocking when I see that, and I'm like, why at least not consider looking at the personal bank concept and looking at using a high dividend, high cash value policy to create that income for you? It's so funny. It's not funny, really, how it's just I never see it talked about, hardly ever, on any of these articles. Another article I was reading was talking about all the different options like savings and CDs and high interest checking accounts and those kinds of things. Talking about annuities and all the different places. And they talked about bonds and dividend paying stocks. Bonds are getting like this particular articles even talk about how it states that the dividend paying stocks are doing better than the bonds. And the bonds or the dividend paying stocks are 1% to 3% range. So I'm thinking, oh my gosh, what are the bonds doing? Like I said, dividend yields are higher than bond yields. Well, if they're 1% to 3% range, like this article states, in my opinion, that's just not very good. Particularly when I understand there's an option, there's an alternative that's been paying 6% for the past 25 plus years and never missed, and not just one company, multiple companies. Okay? That's what I'm saying. If you're looking for income, you're looking for dividend payers, you're looking for interest, you really need to consider looking at your personal bank. And that's why I'd say contact us at yourpersonalbank.com. I'll show you the chart of all the different companies and what they've paid for the last 25 years, all the top dividend payers. You'll see immediately. Okay? And that's the number one probably reactions of surprise I get from folks is, wow, why didn't I know about this all along? Well, they've been just quietly doing it year after year after year, some of them since before the Civil War. Okay? So this is not new. All right? Example I'll share with you just happened this past week with a client. One of the articles talking about places to put your money was, talking about high income, high interest savings accounts and money markets and, things like that. I have a client, this situation, she had put away some money, high interest savings accounts, online banking accounts, and was making 2-3% on most of these even a year or two ago. Looked at the statements currently, they're all at 0.7 or less. One of them was 0.3, and these weren't small amounts of money. She had significant amounts of funds in several of these accounts, all of them earning well below 1%. And so my point to her was really simple, and she already had, interestingly, she had already set up a high dividend paying insurance policy 15 years ago, long before I ever met her. And it had performed quite well. In fact, it paid off her house a couple of years ago when she retired. And she still has a significant amount of money in it and growing. In fact, it's continuing to grow at roughly that 6% rate over the past 15 years. And even without paying it back, she has no plans to pay that money back that she used to pay the house off. She wiped out her mortgage. Okay. And, it's still growing. And I showed her how she can get positive arbitrage with it by bringing the bank line of credit, so she even likes it better, right? But my point to her was just real simple. I said, look, what if you can keep the money in the bank accounts. I understand having emergency funds. She had far more than she needed for emergency funds. It just kind of built up over time. But the reality is she was making so little on it, less than 1%. I said, look, what if you did this? What if you funded it into a policy, and we're going to do, and I'm going to talk about this a little further, but what we call a front load, and get the 6% dividend. Now, granted, that's 6% taxable, but so was her bank accounts. And we'll talk about a little bit further about the tax consequences and why That's not such a big deal, frankly. But I said, what if you put it in here and made 6%? Well, that's nearly 10 times increase. It was a tenfold increase on returns based on what her average returns were in this money in this high interest, quote unquote, high interest savings accounts. Like she said, she kind of laughed about it. When you say high interest savings account, it has a 0 point something in front of it. That's hardly what I would consider high interest savings, but that's the reality of the world we're in today. But I said, you get 6% instead of less than 1%. And then, even if you access the funds and spent them through the bank line of credit, remember, if you're earning 6 and you're getting charged in the 3s, what's your money doing? If you've listened to any of the previous shows, you're going to know that answer. It's still making money. It's still growing. If you haven't listened to any of the previous shows, go to yourpersonalbank.com and listen further on more about how the Your Personal Bank concept works, more in depth, or contact us. We'll be happy to talk to you. But my point to her is simple. Why not earn 10 times more than the average she's earning more? Her average was about 0.6, by the way, 0.5, 0.6. Now she's going to earn 6. That's a tenfold increase, folks, on average rate of return. And both are safe. Both are have guarantees. I mean, all this good stuff, right? And even if she then spent the money by accessing it through the bank line of credit, she would still pick up between 2 and 3% positive arbitrage. So, in fact, I said to her, even if you spent the money, later spent it through the bank line of credit, you would still make 3 or 4 times more rate of return on the money, even after you spent it, than you are right now in the bank. And she got it. She immediately understood it because, again, she already had a policy. She had already paid her house off before. She understood how this works. She just laughed and said, that's just like such a no-brainer. That was her comment. And she's right. So my point is simple. If you're looking for income, interest, dividends, those kinds of things, particularly to do things like supplement retirement or supplement your income or whatever, and you're considering bonds or different dividend-paying stocks or bank accounts or CDs or any of those types of assets, you need to consider your personal bank also. And if you don't, frankly, you're doing yourself a real disservice. Because in most cases, and everything I'm seeing particularly this year and beyond, but it's been that way for years and years and years, we're getting a much better rate of return for folks. Also, in most cases, we can get them tax benefits, either tax deferral or even income tax free, depending on how we set it up, which I'm going to talk about more in the next segment, again, on how we set it up and do that. But my point is we're doubling and tripling, and in this case, this lady's case, tenfold, 10-time increase rate of return on safe money with access to the money, just like she has now, plus plus tax benefits that she didn't have previously. As her statement was, this is a complete no-brainer. That's the response, and that's the experience I deal with on a daily basis with folks. So contact us at yourpersonalbank.com for more information. And stay tuned in the next segment. We're going to talk about how we get those tax benefits for folks. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, welcome back. Today we're talking about income, dividend paying, interest earning, supplement your retirement kind of stuff. Where do you go to find a decent rate of return these days? Interest rates have been extraordinarily low for the past decade or so and look like to be continuing for the next couple of years, if not longer. You know, all these different articles talk about these different options. A lot of people discuss bonds, dividend paying stocks, CDs, annuities, money market accounts and all these kinds of things. And even this one article talks about how dividend yields on dividend-paying stocks are higher than bond yields. Okay, well, that's great. They talk about the dividend aristocrats. These are companies that have been increasing their dividend every year for the past 25 years. Also great. Then they point out the dividend yields for companies like Walmart and Coca-Cola are 1.49 and 3.29. Not so great. My point is simple. Nothing's mentioned here about high cash value dividend paying policies. If you can do a dividend-paying stock, why not look at a dividend-paying insurance policy that's been paying 6% for the past 25 years? And it's been paying dividends, never missed since before the Civil War. Why not take a look at that? That's my point. And why people are so surprised that even exists, which is a very common response I get when I talk to people and show them the rates and show them the history and everything else of all the different companies, not just one, multiple companies. And these are A-plus rated, billions in cash reserves, been around for over 100 years. Like I said, many of them have never missed dividends since before the Civil War, literally. The fact that people are even surprised by that really tells me that the level of education and knowledge and it's our fault. The financial industry, the insurance companies themselves, have done a particularly bad job of educating and getting the word out and letting people know that this actually exists. And shame on us. And I guess that's that is a big part of the reason of why I agreed to do this show. When I was approached about doing this over a year ago, I had some hesitation. Frankly, I was busy. I was busy working with a lot of clients and doing my business. And would I have the time to be able to carve out to be able to record and do these shows and go on the air and share this information and all this kind of stuff? My goal has always been to educate. So it was kind of fit right up my alley. So it was a fun endeavor to try. So that's what I did. But it's gone so well. They've asked me to increase the show dates and increase the hours, and which is great. And so getting the word out to people, I guess, has become the mission. I'm sorry, but I'm not saying dividend paying stocks are bad. I'm not saying bonds are bad or annuities or CDs or anything else. But what I am saying is to not even consider it as an option, not even listed as one of the options to even look at, is a disservice to people. And when you've got companies, again, that have been paying 6% dividends for 25 years plus and have never missed a dividend since before the Civil War, and not even to bring it up, that is an absolutely flat-out disservice to the consumer, the client. To not even, whether you decide to do it or not, that's entirely up to you. But to not even bring it to your attention, to not even allow you to take a look at it or consider it, the industry, I feel, in the most part, has done a disservice. And they always talk about these fiduciary interests and have the best interests in client's best interests in mind, and all these buzzwords we hear out there. But yet when you have a client, these articles, I run into it, it's just frustrating to me because you hear it over and over and over again. You see it over and over and over again. Here's the things you should look at to generating income to supplement retirement, interest, dividend payers, all this. And it's never high cash value dividend paying insurance policies never seem to make the list. Obviously, there's a bias. And for the most part, there's a number of reasons behind it, but for the most part, there's a lot of advisor or agent bias against it. And frankly, what it is, a lot of it is not lack of understanding and various other things. But it's not about the advisor. That's what when I work with agents and advisors and educate and train, which I've done for going on a couple decades now. And one of my biggest pet peeves I share with people all the time is there's no such thing as a bad financial tool. They all have a purpose. They're designed to do different things. And just because you may like one tool or not, or maybe a good fit for you or not, doesn't mean it's a good fit for your client or not. And when what I'm trying to say is here, I can't see where anyone logically can argue that if you're looking to supplement retirement, you're looking for interest dividend paying type stuff, interest bearing earning type of investments, and to not even consider, not even to bring up, or just to brush it off and not poo-poo, you don't want to look at that. That's not for you, da-da-da. And understanding that companies paying 6% dividends for the last 25 years and not even really to seriously consider it and run the numbers and look at it, I'm sorry. That is doing the client a disservice. That's my stance. That's my opinion, but I think it's a pretty solid one. That's really strong. And I've shared that comment and that stance and that opinion with many, many advisors and agents over the years. And 100%, it's been 100% agreement when I share that. They're like, yeah, you're right. But I don't do it for what, and then they give me their reasons why they don't. And most often it's just lack of understanding, really understanding how these things work. It's hard to focus on lots of the financial industry is complicated. There's a lot of different areas. I get it. And I'm a specialist, so it makes it easy for me to focus on this because I don't focus on a lot of the other things. But when I look at rates, like I said, dividend-paying stocks, and this article is telling me they're doing better than bonds, okay, and they're telling me they're paying out 1% to 3% range. Well, that just doesn't make me very interested to share that a lot with a client or want to know a whole lot about it, but I know I can get them twice that or 2 to 3 times that rate of return. You see my point. So again, if you're not looking at it because of something you heard or you just if you never considered it, okay, that's one thing. You should contact us at yourpersonalbank.com. I'll be happy to talk to you and show you the numbers, show you the rates, show the history and what's been going on. You can see yourself. Check it out yourself. If you're not looking at it because you've heard or somebody said you shouldn't or it's a bad thing or some negative comment or whatever, then I'm going to say shame on you. Because what you're doing is you're listening to somebody else's negative bias. It's not good advice. It's not good. It's not good advice not to at least consider it and run the numbers. You know what I'm trying to say? And so that's all I'm saying. Look at it. Look at the numbers. Compare. And the other thing that drives me a little nuts too is I saw an article just recently, a day or two ago, and it talked about where to put your money if you want to put it away for 2 years and then start a business. And they were talking about the various safe options out there. Again, the same type of thing. Bonds, dividend-paying stocks, CDs, money markets, and then they even put in annuities. Now, I'm a fan of annuities for the right purpose. I've done millions of dollars of annuity business over my career, but it's more of a longer term. Here's my problem with that. The premise was you're going to put the money away and put away for 2 years and then start a business. Well, I'm sorry, folks, an annuity is not a good fit for that. And here's why. And I understand. I like annuities for a lot of reasons, to supplement income and things like that and save money, but not for 2 years because there's a 10% free withdrawal available. It's about 10% of the money is available in just about every annuity that exists. How is that going to be a good fit when you only access 10 or 20% of your money in 2 years? You see my point. Annuities are a good tool for the right purpose, just like any other tool, but not for that purpose. And your personal bank would have been way better. Stay tuned the next segment. I promise I'll get to the tax part. I got off track, but I'll get to it next segment. I promise.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, we're rounding third. We've been talking about income. If you're looking for income, dividend-paying, interest-bearing type of assets, investments, so you can supplement income or supplement retirement, that's what we've been talking about. You're in the right place. Because in all these articles we talk about, the reality is simple. They talk about all the different options out there. They talk about bank monies, money markets, CDs. We all know the interest rates on those are absolutely lousy. Our low interest rate environment, historical, has just killed those interest rates. And by the way, I'm the board. You've heard on the thing, the promo. I'm a board member of a bank. Banks aren't paying any interest these days. I had a client just this last week who had a significant amount of money in quote unquote high interest bearing accounts, and she was making less than 1% on all of it. So where do you go? And these articles, here's a Motley Fool article talking about. Dividend-paying stocks, and they're saying it's better than bonds because bonds is one of the other options you hear of. Okay, great. And they're talking about the dividend aristocrats. Companies have been increasing dividends for 25 years consecutive and all that. But when you get to the rates, they're talking about where, these companies are paying between 1% and 3%. And they're talking about companies like Walmart and Coca-Cola and stuff. That ain't great. That's lousy, in my opinion, a lousy rate of return. When you consider it, it's a personal high interest, or I should say high dividend paying insurance contracts, policies that pay 6% for the last 25 years. and never miss a dividend since before the Civil War? Okay, that's lousy. I'm sorry. It's not competitive. How's that? Maybe that's a better word. You need to look at it. You need to consider it and consider and understand that this could be a great option. And I talked about just in the last segment how annuities can be a good fit in there too. They often are paying better than bond rates these days, and obviously these dividend-paying stocks for a longer term. Access to funds. You get 10% access per year. That's the limitation. But if you're looking to supplement income for retirement, that can be a great fit because there's some guarantees, some tax benefits, and you can get a higher rate of return on your money. But there's even a better option than that hardly ever gets talked about. And, of course, that's the personal bank option that we talk about here a lot. And that's the dividend-paying insurance policies paying 6% over the last 25 years plus. Okay? Look at it. Consider it. Contact us at yourpersonalbank.com to learn more. Here's the thing. We also can set these up with tax benefits. Okay, first of all, any of these, irregardless, there's basically two major ways to structure these. And we hear this all the time. People say you can't do that. Yes, you can. We do it all the time. You can do what we call a front load. That's where you dump a chunk of money in all at once. Or you can fund it over time, multiple years, which is gets involved what's called the MEC rule, the Modified Endowment Contract Rule. It's a tax rule that's been around since the 80s. And basically, if you fund it over typically 7 years or longer, it's 5 to 7 years or longer, consistent, relatively equal payments, that's what the tax rule says, you can access the funds from the policy income tax-free. That's one of the major benefits. So you can get the 6% dividends, access the funds. If you build it up over time, access the funds, and access them income tax-free. That's great. But a lot of people say, oh, you don't want to do a MEC because they're taxable. Well, here's the thing. Yes, you can. And the thing is, most people say steer away from it because of the tax consequences. Here's the thing. Don't be scared of something. Unfortunately, a lot of people say that because they don't understand the rules, are not familiar with it, so they're scared of it, they're uncomfortable with it, and they shy away from it. Just understand the rules. If you understand the tax rules, you can go in with your eyes open and not be scared of it. And I find it really ironic, and again, another pet peeve of mine, that so many people, including insurance agents, say stay away from MEC because you don't have to pay the taxes. Well, have you ever heard of an IRA or a 401k? Do you understand there's taxes involved with those when you withdraw money? Do people shy away from them because there happen to be tax consequences when you access the funds? No, I don't see that happening. Just understand the rules, right? Okay, here's the rules. It's really quite simple. A MEC, a modified endowment contract, is an insurance policy that's funded in a short period of time, typically, like we said, what we call front-loaded, where most, if not all, the money goes in up front all at once. Now, what happens? The money grows. If you leave it in the policy, the money grows. I told you earlier, you can get the 6% dividends. We've talked about that a lot today. If you leave it in the policy, it grows tax-deferred. By the way, so does an IRA, traditional IRA and 401k, right? If you leave it in there, it grows tax-deferred. You don't pay taxes on the gains because you don't touch it. Annuities will operate the same way. When you access the funds, you pay taxes on the gains only, not the principal. So my example, if somebody puts in $100,000, we have people doing those kinds of things all the time. And then they access it down the road some point, and let's say it's worth $105. They're going to they withdraw that money, take it through a policy loan or withdrawal. They'll pay taxes on the $5,000 in gains only, not the $100,000 they put in. By the way, that's tax-wise way better than an IRA or traditional IRA or 401k, where you pay taxes on everything, right? So then my point is simple. The tax consequences on a MEC, a modified endowment contract, are far less significant than on an IRA or 401k, yet people do IRA 401ks all the time, don't they? Don't be scared of it. Don't shy away from it. Just understand the rules and understand how it works, okay? Now, like the example I was sharing with my client this past week who had money in quote-unquote high-interest savings accounts earning less than 1%. By the way, when she takes the money, she's taxed on that every year. Okay? So those are taxable. In most cases, are dividend-paying stocks and bonds and other things like that taxable? Yes, unless they happen to be an IRA, 401k type things. The point I'm trying to say is a lot of investments and assets that are in income, interest, or dividend-bearing type of accounts happen to be taxable, or at the very least, tax-deferred. If they're in an annuity, it means you pay tax on the gains only. That's what a MEC, or a modified endowment contract, is. I just pulled back the veil. It's not that complicated. It's just a tax rule, just like any other tax rule. So, can you fund a chunk of money up front one time into a policy and earn 6% dividends? Yes. Can you let that money grow tax deferred? In other words, you leave it in the policy and year to year, have no tax implications? The answer is yes. When you access funds from those policies, do you pay any tax on those type front loads? Yes, on the gains only, not the principal. By the way, it's not nearly. Most people, once they understand, they go, oh, that's not so bad. I mean, I'm paying some tax on money I made. I said, exactly. And that's the thing I wanted people to understand. When you're paying taxes, that's actually a good thing. You don't want to pay more taxes than you need to. I understand that. But it means you actually made money. You made a profit. I mean, it's certainly better than the alternative, right? So my point is, don't be afraid of understanding there might be some tax implications. Now, there's some advanced planning and some other things that we can do to even offset some of those things. But the radio show isn't the time or place to get into all that detail. But if you're interested in more information to share with you how you can do some of these things, contact us at yourpersonalbank.com. Let me show you how to increase the rate of return, particularly on your dividend, interest-bearing, or those types of monies you're thinking about or wanting to supplement retirement. Consider that. Let's run the numbers. Let me show you the difference. You'll be very pleasantly surprised, like most people we talk to. And as always, stay tuned to the Your Personal Bank Show Tuesdays at noon and Thursdays at 1 on Money Radio.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.